What if I told you that HMRC's latest tax rules could quietly take hundreds, maybe even thousands out of your pocket without you even realizing? From frozen tax thresholds to new digital reporting demands, millions of workers, pensioners, and small businesses are about to be hit. And that's why HMRC is now under fire like never before. Could you be one of the people caught out? Welcome to UK Insight, now your trusted guide for pensions, benefits, and senior living in the UK. Stay informed, stay supported, and enjoy your golden years with confidence. Subscribe now and join the community. HMRC, or Her Majesty's Revenue and Customs, is responsible for collecting taxes in the UK. That includes income tax, national insurance, VAT, and corporation tax. Every year, new tax policies are introduced, sometimes to raise money, sometimes to close loopholes, and sometimes, at least in theory, to make the system fairer. But the latest changes have sparked outrage. Many say they punish ordinary people while giving big corporations and wealthy individuals an easier ride. And for those on middle or lower incomes, the rules could mean less money in their pockets at a time when the cost of living is already sky high. So, what are the new tax rules causing all the controversy? One of the biggest changes relates to how HMRC is handling allowances and thresholds. Normally, tax thresholds, the points at which you start paying higher rates, rise each year in line with inflation. But under the new rules, these thresholds are being frozen until at least 2028. At first glance, that might not sound like a big deal. But here's the catch: wages and pensions tend to rise over time, even just slightly. So as people's incomes creep up, more and more of their money gets dragged into higher tax bands. This sneaky tactic is known as fiscal drag. It means millions of people will pay more tax, not because they're actually earning more in real terms, but simply because the thresholds aren't moving. It's essentially a stealth tax rise, and critics say it hits ordinary workers the hardest. Another controversial rule is the tightening of self-assessment reporting requirements. For freelancers, contractors, and small business owners, HMRC is rolling out new digital tax systems, often called Making Tax Digital. On the surface, it's meant to simplify things by moving everything online. But in practice, it means more frequent reporting, more admin, and potentially higher costs for accountants and software. Many self-employed people feel like they're being unfairly targeted, forced to jump through endless hoops, while large corporations seem to find ways to reduce their tax bills. It's no wonder HMRC is under fire. There's also the issue of capital gains tax and dividend allowances. In recent updates, the annual tax-free allowance for capital gains has been slashed significantly. That means if you sell an asset like shares, a second property, or even certain investments, you could be facing a much bigger tax bill than before. Similarly, the dividend allowance, the amount you can earn from shares tax-free, has been cut, meaning small investors and retirees relying on dividend income are now being dragged into paying more. Again, critics argue this penalizes ordinary people trying to save or invest, while big players with complex tax planning strategies often manage to avoid the worst effect. So, why are these rules so controversial? It comes down to timing and fairness. We're living through a cost of living crisis. Food prices are up, energy bills are still high, and inflation continues to put pressure on household budgets. At a time when many families are struggling just to get by, these new tax rules feel like another kick in the teeth. And while the government insists the changes are necessary to stabilize public finances, opponents argue that it's the wrong people paying the price. Instead of cracking down harder on multinational corporations or wealthy tax avoiders, HMRC appears to be squeezing more out of average earners, pensioners, and the self-employed. Let's look at a practical example to make this clearer. Imagine you're earning £35,000 a year. Normally, if wages rise by 5% to keep up with inflation, you'd expect to be in roughly the same financial position. But with frozen thresholds, that pay rise could push more of your income into a higher tax band, meaning you take home less in real terms. Now multiply that by millions of workers across the UK, and you can see why fiscal drag has been called the silent tax raid. It's not just workers who are worried. Pensioners are also affected. Many pensioners rely on the state pension, private pensions, and sometimes small investments. As the state pension rises each year under the triple lock, more retirees are finding themselves paying income tax for the first time. And under the new rules, with thresholds frozen, even modest increases in pensions could drag thousands more pensioners into the tax system. That means some pensioners, who may have worked their whole lives and carefully saved for retirement, are suddenly being hit with unexpected tax bills. For people living on fixed incomes, this can be devastating. And then there's the question of trust. HMRC has always been seen as strict but fair. Yet these new rules are leading many to question whether fairness has been thrown out the window. Critics say the system is becoming more complicated, more burdensome, and less transparent. Some tax experts argue that instead of simplifying things, HMRC is layering on more complexity, leaving ordinary people confused, stressed, and at risk of penalties if they make mistakes. But it's not all one-sided. Let's be fair here. The government defends these tax changes as a necessary step to repair public finances after years of economic shocks, from the pandemic to rising energy costs and global instability. They argue that without these measures, funding for essential services like the NHS, schools, and pensions would be at risk. Supporters also claim that making tax digital will eventually make the system easier and more efficient, reducing errors and making sure everyone pays their fair share. But even with those arguments, the backlash continues to grow. So what can you do about it? The first step is awareness. Many people are completely unaware of how these rules will affect them. They don't realize that a simple pay rise or pension increase could push them into higher tax brackets, or that selling a small investment could trigger a tax bill larger than expected. By staying informed, you can prepare ahead of time. That might mean adjusting your saving strategy, seeking professional advice, or simply setting aside extra funds to cover possible tax bills. If you're self-employed, it's also worth getting to grips with the new digital reporting requirements now, before penalties kick in. Another important step is checking allowances. Similarly, if you're close to retirement, you may want to carefully plan when you take income from pensions to avoid being dragged into higher tax brackets unnecessarily. And let's not forget about public pressure. These rules are controversial because people are speaking out. From newspapers to campaign groups, there's growing awareness of how ordinary taxpayers are being squeezed. If enough people raise their voices, there's always a chance the government could reconsider or adjust its approach. Thanks for watching UK Insight Now. Don't forget to like, subscribe, and share with other seniors who need this info. See you in the next video. Stay well, stay informed.